Hello, good day. I'm Yok Yi Khan from Hang Lee Business School, University of Reading, Malaysia. Today, I will talk about fundamental analysis. I'm truly delighted to share this topic with you, as it reminds me of the early days of my career when I was working as an investment analyst in a stockbroking firm. Fundamental analysis was a technique that I used to apply day in, day out, those years in the industry. I truly miss the fun, the lifestyle of keeping up to date about the latest development in the stock market, the use of Bloomberg database, the many late nights of analyzing company performance. Those are really my unforgettable experience and memory as a fundamental analyst. I think such industrial experience was invaluable to me as I can teach this topic based on real-world application. The objective of this video is to give an overview about the basic valuation process involved in fundamental analysis. We shall explore how fundamental analysis is related to economic analysis, industry assessment, as well as company valuation. Ultimately, this knowledge can be used to support investment decision making. It is hoped that at the end of this video, you will have a basic appreciation of fundamental analysis, which will motivate you to learn more about the methodology. Let's learn together. Fundamental analysis is the in-depth study of the financial condition and operating result of a firm. It is the valuation of stocks based on fundamental factors such as company earnings, dividends, growth prospect, investment decision, liquidity of its asset, the use of debt, profit margins, interest rates, risk, and so forth. The goal of fundamental analysis is to determine a stock's equilibrium price or intrinsic value. Fundamentalists, those who practice fundamental analysis, hope to earn abnormal returns by being able to identify mispriced securities. Fundamental analysts believe that at any time there is a basic intrinsic value for the aggregate stock market, various industry or individual securities, and that this value depends on underlying economic factors. The efficient market advocates believe that the market is so efficient in processing new information that securities trade very close to their true value at all times. Therefore, it is virtually impossible to consistently outperform the market. The efficient market hypothesis predicts that most fundamental analysis is doomed to failure. If stock values are already based on the analysis of all available public information, it may be assumed that little is to be gained from additional fundamental analysis. Let me ask you some questions. Is the efficient market hypothesis correct? Is there a place for fundamental analysis in investment valuation? Interestingly, most finance theorists and practitioners would answer yes to both questions. Although the financial markets are generally quite efficient, they are by no means perfectly efficient. Pricing errors are inevitable. Those individuals who have conducted the most thorough study of the fundamentals of a given security are the most likely to profit when errors do occur. Fundamental analysis operates on the broad premise that some securities may be mispriced in the marketplace at least some of the time. If securities are occasionally mispriced, and if investors can identify mispriced securities, then fundamental analysis may be a worthwhile and profitable pursuit. Fundamental analysis uses information concerning the current and prospective profitability of a company to assess its fundamental value. Fundamental value is also known as fair value or intrinsic value in different textbooks. It is the underlying value based on a company's asset and profit potential. The purpose of fundamental analysis is to identify stocks that are mispriced relative to some measure of true value. The entire concept of stock valuation is based on the belief that all securities possess an intrinsic value, that their market value will approach over time. When the intrinsic value is greater than the market price, an analyst will recommend that clients buy the stock. When the opposite is true, the analyst may issue a sell recommendation. The two most common approaches used by fundamentalists to value stocks are the discounted cash flow method and the multiplier approach. The multiplier approach is also known as relative valuation technique. The important variables to estimate the discounted cash flow are earnings per share next year, the growth rate in the earnings per share, the dividend payout ratio, and the type of growth, such as constant growth, two-stage growth, or three-stage growth. The multiplier approach involves estimating the stock's price-to-earnings ratio and its expected earnings next year to determine its value. Different multipliers such as price to sales or price to earnings before interest, taxes, depreciation and amortization, EBITDA, are also used. There are two general approaches to the valuation process. First, the top-down approach, and second, the bottom-up approach. Both approaches can be implemented by either fundamentalists or technicians. The difference between the two approaches is the perceived importance of the economy and industry on the valuation of a firm and its stock. Advocates of the top-down approach believe that both the economy or market and the industry effect have a significant impact on the total returns for individual stocks. In investment, it is the future that matters. To understand the future prospect of a company, analysts should have a good knowledge about the company's current condition and its ability to produce earnings. Fundamental analysis helps investors to predict the future by looking at the past and determine how well the company is situated to meet the challenges that lie ahead. Valuation is based on economic factors, industry variables, analysis of the financial statement, as well as the future outlook. Quantitative stock analysis always need to be complemented with qualitative analysis of the strengths, weaknesses, opportunities, and threats facing a company. Now, let's have a quick quiz to test your understanding. Which of the following are used by fundamental analysts to determine proper stock prices? The answer is earnings, dividend prospect, and expectation of future interest rates. Trend lines and resistance levels are indicators used in technical analysis. I will teach you technical analysis in upcoming videos. Hopefully, I hope you have learned something from this video. See you and goodbye.